Hey everyone, it's Norm Farrar, aka the Beard Guy here, and welcome to another Lunch with Norm, the Amazon FBA and e-commerce podcast.
Lunch with Norm, lunch with Norm, lunch with Norm, lunch with Norm.
Okay, today we're going to be talking about the trends for Amazon aggregators for 2022 and what brands need to know. I think this is going to be a really great episode. We've got some amazing guests on the show today, and there are sponsors. So our guests are from Global Wired Advisors, a digital investment bank and sponsor of the show. So guest one is Rob Salmon. He's the head of research and looks to build a world-class research platform on companies in the digital consumer sector. And my buddy Joe Hogg is the managing partner and was the global head of funding for Wells Fargo Trading and Investment Bank Division at Wells Fargo Security. So we'll welcome the guests in a second, but first, let's have a word from our sponsor.
I wanted to give a quick shout out and say thank you to Global Wired Advisors for sponsoring this episode of Lunch with Norm. Global Wired Advisors is a leading digital investment bank focused on optimizing the business sales process. For more information, please call Chris Schifferling and his team over at globalwiredadvisors.com.
Okay, where is the Squire?
All right, hello.
Last episode of the year.
That is Friday.
I am right.
No,
Am I?
We got a day special. No, you're not. It's New Year's Eve on Friday.
Okay, all right.
So
I'm ahead of myself.
One almost, yeah. But yes, welcome everyone. Hope everyone is doing fantastic. How are your holiday weeks going? We've got Old School joining us. Welcome, Rad, Jeff, Jessica Rabbits. It's great to see all of our beardos. Yeah, let us know how your Christmas and holidays are going. We'll be back in the studio Friday, so it should be back to normal. And yeah, so if you're new to the show, remember to smash those like buttons, give us those thumbs up. Also, if you're looking for a fantastic community, as I may say, the Lunch with Norm, Amazon FBA, and e-commerce collective, that's where all the good stuff happens. You can join there. And also, if you're looking for replays, you can check out our YouTube channel. That's Norman Farrar. And that's where all of 235 episodes are, I think, maybe 240 now. So yes, Jeff, Happy New Year's. Yeah, let me see. I think that's about it. We can kind of jump in today. Today we have two guests, and yeah, it's gonna be fun. So
yeah, and we're going to be talking about the trends. I think this is really important going into 2022. There's a lot of different trends. And I've seen, just one sec, another frog in my throat. I've seen Joe talk about this in an event, and it was fantastic. So if you don't get it all, we are going to be posting the reports in the show notes, so you can go back and refer to them. But it's going to be fantastic information. All right, so I think that's about it. If you have any questions, throw it over into the comments section. And so sit back, relax, grab a cup of coffee, enjoy the episode, and welcome Rob and Joe.
How we doing?
Good.
Good. It's good to be on the show.
How you like that little sponsorship thing?
We like it. We like it a lot. We love being promoted anywhere and everywhere we can.
And we like you for sponsoring us. So
Sure.
Anyway, let's get into this. I think you talked, was it at the Billionaire Dollar Summit, Seller Summit?
BDSS, yeah.
And that's where you gave this report first, wasn't it?
No, actually, that was a slide deck I went through that, was a little bit more general. It looked at broader trends in the economy. The report we're going to be looking at today is specific to the niche buyout class, the aggregator, the Amazon aggregator. And in putting the report together, and frankly, in kicking off the research effort, which Rob is heading up, we felt that there was really a void in the market. There was really a spot that needed to be filled with respect to analytical research, rigorous analytical research, and that's what these focus reports are designed to do, is to fill that need. So at BDSS, I went through broader trends that would impact valuations for 3P sellers, and we'll be touching on that probably in future focus reports. But this focus report, and I don't know if you have the other one as well, we're going to be looking at specific things. This first one is, again, the aggregator space and what we're seeing and what we believe we're going to see going into 2022.
Okay, and we do have the ability to share the screen. If you're on a podcast, we'll be sharing those in the show notes. Plus, we're going to be describing them in detail as we move forward. Okay, so I'm not sure where you want to start. Who wants to take it away, Rob or Joe, on the report?
I'll kick it off, and I'll let Rob jump in.
Okay.
I think if you can scroll perhaps to let's see, maybe page 4, exhibit 6. There we go. So, I think a lot of people on the podcast are pretty familiar with the platform, with the Amazon ecosphere. So we probably don't need to go through a lot of the introductory material that we put in the first part of the report. A lot of that was really aimed at people that are outside of the space, that are trying to learn more about the space, particularly investors, people that are in venture capital, that are trying to understand the Amazon world. But this is a pretty good chart as we get into year end, and we have the holiday shopping season behind us to contemplate. So, obviously the pandemic was a boon for online sellers, where we saw just a tremendous shift from spending in the U.S. economy away from services toward consumer goods. Obviously Amazon 3P sellers, 1P sellers, everyone on Amazon pretty much benefited from it. But now that things are getting back to normal, Omicron set aside for the time being, we're seeing more normalization. We're basically seeing the service economy open back up, and we're seeing more shopping taking place, frankly, in malls, away from e-commerce platforms. So this chart is kind of showing you that trend was really underway prior to getting into the current holiday shopping season, where you can see the convergence of the blue and orange line, the blue line again being e-commerce sales and the orange line being brick and mortar sales. We're getting back to pretty much where we were, from a split standpoint. Now, I will say the holiday shopping season, which I guess is now defined as November 1st through December 24th, people are shopping earlier. For e-commerce, it was up 11% year over year, and 21 over 20, which is pretty good considering that the pandemic really juiced online sales. So overall, that held in pretty well. It held in better than we thought. It was kind of spread out, where we saw a lot of people shopping earlier. But generally speaking, sales were up. They were pretty good, but this normalization is happening, and this normalization is going to have consequences through the aggregator space. And that's really the point that we make in the report, is that a lot of deals were done where things were a little pricey, things were overvalued, where people were extrapolating a lot of pandemic growth well into the future that was going to revert back to mean. So that's something that we address in the report. But I thought that this was a good way to kind of dive into the report. I don't know if you want to add anything to that, Rob. Or...
Yeah, just to piggyback on what Joe said, that 11% growth was according to MasterCard. And, I think true holiday season actually began in October. So the October, if you include part of October, the numbers would be even better. I was actually surprised that we saw online sales actually outpace broader retail sales, according to MasterCard. We haven't yet gotten the Census Bureau data, which candidly I prefer, and they were showing that e-commerce actually grew to about 20.9% of total retail sales versus 20.6%. And they're excluding some automotive sales and gasoline, stuff that you can't or typically don't buy online. So we're continuing to see this just really fast growth of e-commerce sales. And I think the first quarter will be in terms of year-over-year comp, tough. But then as we look out into the back half of 22, we should start to see more normalization back to the trend growth that you're seeing in Exhibit 6 of our aggregator report of about, call it 15% growth that we've historically seen with e-commerce.
Yeah, and I even wonder, especially with Amazon, if you're going to see this continued growth, because we haven't even, like, it's gift card season now. Everybody's spending their gift cards up until probably about mid-January, even late January now. So we're probably going to see that. Would you agree?
I totally agree. Gift card season and return season, right? You get something that isn't quite right for you during the holidays, and you spend a little bit more to get, whatever it was that you were really kind of craving during the holiday season. That gift card season definitely extends it, the holiday sales, and that's a good thing for both online sales as well as brick and mortar.
I never really thought about this, and it's a little off topic, but if you get a $20 gift card or a $50 gift card, psychologically, I'm sitting there going, oh, if I could buy something for $75 and I can spend the 50 and I only have to spend an extra $25, there's additional sale. I really I always thought gift card sales were just kind of a wash, right? Somebody bought it, they bought it back in November or December for somebody. So the sales were then, but you're probably seeing an additional 20% because who buys just their gift card? I don't know about you, but I always overspend. Like, oh, I got $20 here. I'm going to spend 30.
Well, if you ask my wife, it point blank exactly what you're saying, where she'd find something that's absolutely perfect, and if it's an extra $10, we're getting the right product. So I agree with the premise from both a personal perspective as well as the economic tailwinds that we typically see with any sort of stimulus that goes into the economy. And certainly we saw that during the pandemic when the government wrote a bunch of checks to help us get through a really tough time.
Right. I am very curious to hear what you guys have to say about the, we saw crazy multiples with aggregators over last year compared to the year before. A year before, I would probably think the average business sold at, at 2.5 multiple. It had a valuation, and it was a 2.5 multiple. And this year, I've seen it as high as 11. I've seen a bunch of companies selling around 7, but anywhere from 4 to 2.5 to about 7 would be the range that people were selling their companies for.
Yeah. So, like I was saying with respect to the chart that we were looking at on Exhibit 6, we have seen a normalization in e-commerce trends. And I think when we were in the thickest part of the pandemic, there was a tendency to extrapolate a lot of that anomaly into the future, and people got really excited about what the growth prospects could be, and they are quite good long term. A lot of money entered the space from the standpoint of venture capital coming in and funding a lot of aggregators. There were a lot of deals to chase, but we have seen some normalization. We've seen trends basically get back to where they were prior to the pandemic, which is not bad. I mean, e-commerce is typically growing at somewhere between 15 to 20% a year, so it's a great spot to participate in. But growing at 40 to 45% a year was not sustainable at the time. It felt like it might have been, but it just wasn't. So I think what you're going to see going into 2022 with respect to multiples is good companies are going to continue to trade with premium multiples. I think if you see growth kind of flatlining, or you're having trouble with year-over-year comps, you're probably going to see a little bit of an air pocket from a premium multiple down to a multiple that might have been closer to what you could have expected in 2019. That's what we think we're going to see, is a little bit of a bifurcation in the market from a multiple standpoint.
What about a non-traditional format? So Amazon is saying that brand is everything right now, building your brand community. And so as a business person, and I want to start selling soap, and I want to put a lot of money into the brand. And we do have something that's going on right now that we've just pouring tons of money into the brand. So instead of seeing huge profits the first year or the second year, you're probably either losing or you're maybe making a point. You're not making much at all. But all your emphasis is going on to the brand for future growth. Are you going to see that come into effect instead of the normal way of doing your market valuations?
Whoa.
I don't know. All right, let's try that again. Okay, Joe, I think you're on mute.
Oh, am I?
There you go.
Okay. Am I back?
You're back.
Okay, good. Good deal. Well, I think brand is important. The thing that we're seeing now I guess something that's quite new with respect to brand evolution, new within the last 5 years or so, is that the life cycle for a brand is much shorter than it was in the past. If you think back 10, 15, 20 years ago, brands like Nike, Adidas, they had very long brand life cycles. Now a brand can be basically launched on Amazon in the span of a couple of months. It can be acquired and scaled in the span of maybe 2 years, and it probably reaches some form of maturity within the next 2 years, unless it is a breakout brand that grows much further than that. And as a result of that shortened, compressed brand life cycle, we have a lot more brands. We have just thousands and thousands of brands that are coming online and showing up all of the time. And I think that investing in your brand is going to be important because the field is a lot more competitive. I think that you've got to find differentiating factors with respect to building brand permanence, so that you first are going to be attractive to, say an aggregator or a corporate strategic or a strategic sponsor. And you're going to have a brand that can play, that can compete, that can swim against all these other brands. So I think a brand oriented approach is definitely the right approach, as opposed to trying to build a product and generate sales and take market share. I think that's fine for a quick start, but I think that you're going to get more long-term success if your brain is brand oriented.
Rob, do you have anything else?
Sorry, I'm just to piggyback on what Joe said is,
Yeah.
If we see that kind of top line growth come through a year after, that investment in the brand is a fantastic investment, but it should all be driven by the return on invested capital, where you think the business can grow over time. Because putting capital to work, if you're not getting the returns you're expecting, you'd actually be better off de-emphasizing the investment. But if you're able to kind of drive the sales and the profits in future years, but you're just kind of creating a strong brand recognition, it's worth every penny, as long as you get the recurring sales.
I'm glad you said that. Okay, where is the next step? You brought up the report. Let's go to the next section in the report you want to talk to us about.
Sure. So I guess just kind of panning through the report, it might be good to touch on page 8.
Mm-hmm. And by the way, everybody, the report, it will be available in the show notes. So if you want to download it and check it out for yourself, this is incredible insight.
Thank you. So the point that we make here in Exhibit 13 is that for a lot of 3P sellers, their profitability is usually concentrated in hero SKUs, 1, 2, or 3 SKUs that are the breakout original SKUs that drove original success. And there are a lot of tail SKUs typically that were kind of tag-along SKUs that are actually a necessary part of product development and brand evolution. You have to continue to develop your product roadmap. But what we typically see is just 1, 2, or 3 SKUs that are driving most of the profitability. And from just looking at the economics at the SKU level, you can see that, if we attribute cost across the different SKUs, you can see that a lot of the tail SKUs are really not profitable. So this is something that aggregators will look at. They'll look at tail SKUs and the profitability or lack of profitability in a number of tail SKUs, and it could be a way of increasing profitability. If you were to eliminate these tail SKUs, you would pick up, another 100, 150,000 of profitability. It doesn't necessarily mean you're in a good spot to continue to develop the brand, but this is a pretty common profile that we see. So it's something to understand. And I guess what I would do next is I would pan down to page 13, Exhibit 21.
And just to kind of add to what Joe just said there, a lot of the purchasers of Amazon brands want to see that dominant SKU, what we define hero SKUs, because it makes it an underlying business moat where you've got a great product, people love to purchase it. It's gotten a lot of really good reviews. It's just an attribute that people are looking for.
Definitely. So here, what we've done is we've taken that same profile and we've shocked it with a 10% decline in unit sales all the way through each SKU. And you can see what the net result is. The previous EBITDA was 720,000. When we reduce unit sales through these, 10 SKUs by just 10 percentage points, because profitability is concentrated in those 1 or 2 SKUs, and you are profitable in the other SKUs, when we do that, the tail SKUs become a lot less profitable, and so do the hero SKUs. So just a 10% decline in overall unit sales across all SKUs leads to a 42% decline in EBITDA. So it's something to keep in mind that's unique with respect to most 3P sellers. This type of I guess SKU layout, hero SKU, tail SKU layout. So the point that we make in the report, the aggregator report, is that when you acquire a lot of 3P sellers that have this particular profile and you use debt, in some cases a significant amount of debt, 3, 4, 5, 6 times leverage, you can find yourself in trouble very quickly. You can find that 42% reduction in EBITDA unlevered with 3 or 4 or 5 times leverage can quickly go negative. And going back to the comments I was making earlier about trends in e-commerce and how things are normalizing, and how during the pandemic we saw sales trends 40%. Well, I think there were a number of aggregators that made acquisitions when things were looking pretty rosy. They used a fair amount of debt, and they're looking at a P&L profile that's very similar to this, except much worse because of the leverage, because of the debt payments that they have to use, so that they have to pay. So that's something to keep in mind. I think going into 2022, we haven't really seen any significant fallout in the space yet. I think to date, there are 73 or 74 different aggregators. They've raised a lot of money and they're continuing to raise money. And the outlook for the group as a whole, and for Amazon, of course, is very positive. But I do think that there were a number of aggregators that did get caught at the highs using leverage, and they've got cash burns now that are heavier than they would prefer. So, so I think we're going to probably see some reallocation of capital maybe in the first part of 2022, in the first quarter. I think a lot of people were waiting to get through the holiday shopping season just to see how it went, and I think you might see a little bit of fallout. But again, long term, everything's good.
It'll be interesting to see what happens, because it seems like everybody and his mother is an aggregator right now. And, good aggregators, bad aggregators, and ugly aggregators. But, just to see where it'll fall out. With a few of the aggregators, I've been able to see their portfolio, and it's pretty ugly. Like it made no rhyme or reason what they're, and I'm not saying everyone, but certain ones that I've seen, and I don't know where that's going to fall out. And this is an interesting question, because I don't know if you know, but why would you be just buying anything that's out there? Literally, it was all over the map from some of the guys that I've seen.
Yeah, it was a land rush, and I think if you view it from the standpoint of what the end game is, then it all kind of makes sense. The end game is to eventually execute a public securities transaction, to get over the wall, so to speak, where you can realize multiple expansion. You can go from marking to model, which aggregators are largely doing now, to CPG multiples that are publicly traded. It is still very much a theoretical exercise, because no one has gotten over the wall. No one has gone public yet. Thras has gotten close. But when you see that as the prize, and we denote that later in the report as the prize, then you go, well, gosh, if CPG multiples are 15, 20, 25, and I'm making acquisitions of 5, 6, 7, 8, then when someone does get over the wall, or I get over the wall, then I'm going to realize that uptick in value. So I need to acquire as many things as I can, as fast as I can, that I'm comfortable with at 5, 6, 7, 8, knowing that I'm working against multiple expansion with respect to the CPG multiple takeout. So that's what drove a lot of the land rush mentality, I believe.
And there's also a theory of, hey, if I'm able to expand the EBITDA, there will be a natural multiple expansion before you go and are able to achieve the prize. And Norm, I think you brought up a great point earlier in the discussion, is that there are going to be different levels of performance amongst the aggregators. The business model at its core is a pretty interesting business model, where you're buying a lot of asset-light businesses, paying at the time lower multiples, and can achieve multiple arbitrage, potentially even diversify the risks of the different brands that you own, or different underlying sales that you have on Amazon. Maybe you're getting deeper into one category and you can have better cross sells, or you're able to do some better performance on the logistics side. But if you're just buying broadly, at its face, it doesn't feel like there is logical, easily achievable cost synergies that you can kind of do some takeouts on.
Very good. So before we get to the next question, if you do have questions for Joe or Rob, throw them over into the comment section. If you are having hurdles trying to exit your business, throw it over in the comment section. We'd like to hear about that. And I do want to talk about our giveaway today. So our giveaway today is a month of Centurion League, the calendar that we've been talking about. And we've got one of our listeners, he's just an awesome guy, Alan. He's got chocolates. We're going to be giving away one of his British chocolates. By the way, Kelsey, I'm going to throw Kelsey under the bus right now. Kelsey's going to give away a free consult with social media. Just letting you know, Kels. We never discussed that
All right.
beforehand, but I thought that would be good for, today's episode. So it's a
Good to know.
4-pack. How's that? So all you need to do is hashtag Wheel of Kelsey and then tag 2 people and you'll get an extra entry. And now, Kelsey, get your finger on the button. We're going to go to a message from our sponsor.
Thank you, Cellarize, for sponsoring this episode of Lunch with Norm. Cellarize is your comprehensive solution for your everyday business needs. Everything you need to grow and scale your Amazon business is just one click away. For more information, contact Dima and his team over at Cellarize.com. And remember, Cellarize is with 1 R.
I just want to go back to one thing. I know we're a little bit off topic, but what are your thoughts? What's going to happen with these 70 plus aggregators over the next year or two? They can't all survive.
No, I think you're going to see consolidation. I think that's the most likely outcome. I think that we're going to see a little bit of pressure on the space in the first quarter. I think that the space has actually been under significant pressure over the course of the last 6 months. It's going to lead to business combination. I think that is ultimately what's going to happen. I think you're going to have aggregators that have cash burns that are unacceptable, that have portfolios that they can't tame given their cost structure. Perhaps their G&A is too high. They can't tame that. It's going to lead to them being acquired or merging with another aggregator, I think. And we'll find that again, because the underlying growth trend is so strong and there's still so much interest to invest in the space, a lot of that is going to be somewhat frictionless. I think there are going to be some bumps in the road for sure, but it's going to be smoother than some of the other, let's just say, evolutionary processes that we've seen with financial evolution through the years, where you have exuberance that leads to a little bit of a pullback. Sometimes there can be significant fallout, but I don't think we're going to see it here. I think again, there's so much, the underlying trends are so strong, and there's so much interest still to invest in the space that I think that it's going to make this reallocation of capital among aggregators a little bit more seamless and a little less bumpy.
Okay.
And we've started to actually see a little bit of that. In Europe, there have been 2 aggregators that have bought smaller aggregators. So we're starting to see a little bit of consolidation. There isn't much out there because no one's public yet, as Joe alluded to before. So we haven't seen what the underlying performance of the group is, but we'll be watching that.
Yeah.
Yeah, I think, I don't know about you, but if I was a gambling person, Thrasio is probably going to be the first on the blocks, I would think. Wouldn't you?
Yeah, I think they've gotten the closest so far. They're the largest. I think they're trying like crazy. I think the whole space is going to benefit from someone getting public and there being an actual tradable security and a multiple to mark to, as opposed to marking to a generic CPG multiple. And I think that the whole space has interest in someone getting over that hurdle. And again, Thras is the closest. So if I were a betting man too, I would bet it would be Thras as well.
Okay, so let's get back to your report. Are there any other sections in the report you want to bring to our attention?
Well, no. I think if you want, we can switch over to our latest report, which is on supply chains. I don't know if you can pull that up on the screen, but I think this is something that, in talking about trends and thinking about 2022, should be on everyone's minds. This is how we see the supply chain problem playing out. And I think that there's the possibility that a few key things come together to create what we refer to as a perfect storm. So I don't know, Rob, do you want to run through those factors that could be leading to a perfect storm with supply chains? Oop, I think you're on mute.
Whoops, I was on mute there.
Yep.
So it's obviously been a really tough 21 for everyone who's running a business trying to get product to market. You had caps that Amazon was instituting at their fulfillment centers. You had really slow transit, exuberantly high freight forwarding costs. And, unfortunately, we're going to see higher transportation costs across most modes looking out to next year as your contracts renew. Typically, kind of any year where we've got a major contract renegotiation between the union, the dock workers union, which is the ILWU, and the ship owners, called the PMA on the West Coast, we see all large retailers bring a lot of product in ahead of that because these discussions have always been contentious. We often have, very high demands in terms of wage increases. We also can see the ship owners wanting to put in more automation. These are typical things that the two sides always have to work out. And it naturally can run into a little bit of run into a challenge. And one side gets annoyed and can lock out the other side. So this contract expires at the very end of June. So it'll be termed out in July 1. The ship owners actually tried to extend it by a year, given everything that's been going on. The ILU extended it 2 years beyond kind of where the natural contract ended and say, hey, the collective bargaining is a really important thing and we need to do this. We've been waiting for 7 years for a new contract, and we've been seeing a lot of union successes, and labor has done a lot to try and get through. So I think they want a right to bargain. And that's going to mean what we've seen in the second half of 21, which is just really high volumes entering the US, they're going to stay high. And if we get any sort of lockout or otherwise, things could get even more challenging as we look into the back half of next year. So we think volumes are going to stay tight. Our base case is that we're going to stay kind of where we are throughout next year. But there is the possibility that things could get worse. So if I'm sitting here as a business owner, I want to plan to ship my product earlier. I'm going to run through kind of what my typical seasonal sales are, what new products I want to launch, and build that into my forecast early on. I want to be in constant communication with my freight forwarder, with Amazon Global Logistics, whomever I'm using. I think if you can diversify, and if that's your carrier, where you're producing the product, anything just to give you a little bit more, leeway to try and navigate what, unfortunately, our base case is it looks like it has this year, which isn't a good case. I hate delivering a lump of coal just after the holiday, but I think it's important and prudent to kind of plan your business for how things likely will be playing out, as opposed to some of the optimism that I'm hearing about supply chain situation getting materially improving, because with volumes as high as they are, it just creates natural dyssynergies across the transportation supply chain. And think about it, the transportation supply chain is basically a commute, and you're using the interstate highways to get to and from work. If you lose one lanes on a 3-lane highway on your 30-minute commute, it doesn't go up by a third. It doubles or even worse, or it's even worse, because anything can kind of cause a slight chink, and then that beautifully moving freeway becomes a halt.
Right. Go ahead, Joe.
Yeah, it's interesting. There's been so much talk about supply chains, and we felt it would be good to put a piece out that gave you a background on supply chains, but also viewed them from a realistic standpoint, where we were assessing the risk that things potentially could line up to create a serious problem. And, Rob just went through the labor negotiations, which will be unfolding early next year, which no one's really been talking about, which could be quite contentious given the amount of money that shipbuilders have made over the past year and a half, and given the two sides' nature proclivity toward fighting. But when you stack that on top of already high throughput and supply chains already pretty much operating beyond capacity. And then you throw in the possibility that we could see surging, additional COVID-19 cases from Omicron, the Omicron variant, then things could line up to be quite serious, materially worse. Omicron at this point does not appear to be as serious as Delta. It is highly contagious. It's a lot more contagious, but it's not producing the same level of hospitalization and death. However, the thing to keep in mind is that when someone gets sick with Omicron, they have symptoms, they take a quick home COVID test, they say they have COVID, well, they're not going to go to work for 5 days, right? So the end result is a disruption to the workplace, whether it's truckers, port employees, people on ships, or people that are working in ports in China where there's a zero COVID-19 tolerance level. So in examining all of this, there is a risk that these factors stack up, and the factor that Rob went through, I don't think anyone is really contemplating, and that's a breakdown in labor negotiations. If they were to all line up, then you could see a perfect storm, and that's something people need to keep in their back of their minds. It's not a reason to panic, but I think that like Rob was saying, if you can book things early, if you can order a little bit of extra inventory, you probably should. And another point that we make in the report is you should probably think about raising prices. This is something that a lot of Amazon sellers have not really thought of in the context of an inflationary environment, which we're in now. Typically, the thinking was the other way around, where if you were a seller, you're like, gosh, I got to keep prices as low as I can to pick up as much market share as I can, to stay as competitive as I can, to stay on the first page. Well, now with potential disruption, continued disruption in supply chains that could get worse, and inflation, we're seeing significant increases in CPI, PPI, and even more significant increases in a lot of individual product costs. The thinking needs to be shifted the other way, where you say, okay, well, how far can I move prices higher where I don't lose demand, as opposed to how low can I keep prices to take market share? I think the thinking needs to start shifting, and I think you're going to see it start shifting, particularly as things with supply chains continue to stay stressed in 2022.
No wonder why I like you so much. That's exactly what I would say too. Even if you were debating this, how can I've got a product, how can I bring it up 10 or 20%, or, perceived value, improve the customer experience, do something. It might be just changing around your packaging. And it depends. It really does depend on, the volume, the price of competition, but try changing things around. Like we try to do that when we look at a product. If we can change the packaging by a quarter or 50 cents to get $3 or $4 back, I'll do it all day long. But a lot of people don't do it. They just try to sell the same product, or even if they do, they don't give, if their products already has a very high perceived value, they don't give the product a chance. They're going to be like a bottom dweller, even though you could kind of go into that mid-tier or higher tier. They just don't want to lose the volume, where that's in a lot of cases anyway, could be the wrong way of thinking about things.
Yeah,
such a good point, Norm.
Yeah, especially in this environment. Again, we're entering a new environment from an economic standpoint. Over the course of the past 20, 25 years, we were in a non-inflationary, deflationary environment where, raising prices was very counterproductive to increasing sales typically. and now that thinking is going to get upended, we believe, just because inflationary trends that we're seeing they might peak short term, but they're going to continue. I think we've reached a bit of an inflection point from the standpoint of inflation trends in this country and globally too. So I think that sellers need to start reorienting their thinking toward that type of environment as opposed to the previous one.
And more broadly on Amazon and other online marketplaces, we are actually seeing pricing increasing. According to Profitero, it was up 5.5% year over year in October, up almost 7% in November relative to June of 2020. So we're broadly seeing category price increases. And I think given the inflation that I mentioned with transportation, as well as what Joe had talked about earlier with commodities, it's beholden on you to protect your bottom line and try and figure out, can you get a little bit more in pricing? If you're seeing sales slip too much, you can always backtrack and readjust. But I think you want to press the envelope a little bit to see if you can improve your bottom line.
Yeah.
If I just wanted to add one point, then we'll go to some of the listeners' questions. But I have a partner in Honu Worldwide. And so a lot of the listeners know Afalabi. Anyways, what we've seen, it's probably 50-50, is we used to go to China and we used to be sourcing in China. We had offices in China. And what he's done now, and what we're seeing is about 50% are sourcing either North America, even South America. And it's just that much easier. So, it helps with the supply chain. Who wants to wait to offload, from a ship that who knows when it's going to come into port, when you can have it just very inexpensively come up, in the States, it could be a week, to be dropped off. You don't have to have that long cycle. And one of the biggest things that at least we found is you can turn that inventory so much faster, which is going to improve your cash flow. Definitely. And you could do it instead of on the quarter. You might be able to do it every month. But anyways, it just helps to improve cash flow, and that's a whole other podcast. But anyways, let's get into some of the questions, Kels, because I know we've got a hard cutoff time.
We do. So I'm not sure how many questions we can get to, but we do have quite a few. From Howard, is there still space for the small e-commerce sellers on Amazon, or are the costs and parameters starting to crowd them out?
No, I think there's always going to be space for smaller sellers. I think that if you stay brand oriented, you can go quite far. It doesn't take much to get started on Amazon. I forget, Rob, what the startup cost was that we listed in the aggregator. Was it $5,000, $3,000 to fully launch?
It's very small. Like the majority of sellers can actually bring their product to market for under $5,000, and so that it's often kind of coming from your own place. In terms of the Amazon 3P gross merchandise value, it's over 60%. We thought it was about 62% last year. So we think there is definitely a space for the small seller. It is, you guys are so close to an underlying product, and you can really capture the consumer's attention in a way that I think a lot of big brands candidly can't or don't. So we've got a very positive outlook long-term for smaller sellers, just given the ability to really focus on one product, create something great.
Very good. Next question, Kels.
All right. From Jessica Rabbit, how will aggregators gobbling up each other affect Amazon and e-commerce space PL sellers and likely business models? Predictions of mostly hidden dispositive variables?
Well, I think you're going to see a quarter or two of aggregators looking for acquisitions of 3P sellers and also looking for business combination opportunities among themselves, or looking to acquire already acquired companies to move to their portfolio. So I think that it's not going to be the same land rush kind of opportunity that we saw in 2020, where aggregators were reaching out looking to buy pretty much anything and everything to get cash flow that was, again, extrapolated forward a number of years at an exceptionally high growth rate. I think that there's going to be a bit more discretion in the acquisition process. And I think that it's going to be focused on not just reaching out to 3P sellers, but also in looking at opportunities with other aggregators.
All right.
But in terms of operating a brand, I don't think it's going to have any impact about how your go-to-market strategy is going to be. It's just going to be some incremental noise we're hearing in the broader space. So, focus on the fundamentals. It would be my suggestion to any brand owner out there.
All right, and just let everyone know, I don't think we'll be able to get to all the questions today. So if you do, please post them over into the Facebook group, Lunch with Norm, Amazon FBA, and E-commerce Collective, and maybe we can have a discussion there and get our thoughts from the Beard Nation. So I think we have time for maybe one more. I think this is an important question from Rad. How do you vet aggregators if they're legit or fishing for information?
Well, that's a good question. I think that our recommendation, and perhaps we're biased, is to always use an intermediary. An intermediary is going to know how to interact directly with an aggregator, is going to know how to protect your information, is going to know how to build a market among different aggregators to ensure that you achieve the highest value for your company. So that's going to be the starting point for us is, and again, we're biased. We think Global Wire does that better than anyone, but it's highly recommended that you go through an intermediary to interact with anyone that's trying to buy your company. There's kind of an implied assumption when you take your own deal to market that the multiple is going to be lower. There's an implied assumption among pretty much every buyout class that when you're trying to represent yourself, your company in a transaction and trying to build a market, you're not going to be as successful, and hence the multiple is going to be lower. So that's actually something that aggregators are quite keen on trying to find. They spend millions of dollars building outbound efforts to develop proprietary relationships directly with sellers because they know they can get multiples that are going to be smaller than what could be achieved when an intermediary is building a market looking for the highest enterprise value.
All right. And I think that's the last question of the day, Kels. Is that correct?
Yeah, we'll have to get going soon.
Okay.
It's 3 minutes to 1.
So, Joe, Rob, you've never seen The Wheel of Kelsey.
No, we haven't. What is the Wheel of Kelsey?
Oh,
Well,
sit back.
here we go.
Yeah.
We're looking
It's time for the Wheel of Kelsey.
We like to have fun on the podcast.
Yeah, there we go. So we've got the Centurion League, the calendar with Tim Jordan and myself, the giant box of chocolates, and a consult with Kelsey on social media.
That's right. So I'm going to go shuffle this up and go. So if you are the winner, please email me at k@lunchwithnorm.com. And looks like the winner is
Dun, 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 dun.
Jessica Roslyn.
Roslyn
Nice.
on your big prize.
There we go. Congrats, Roslyn.
Good job.
Okay, well, that's it for today. You guys are going to make your call. You got 1 minute to go. Hey, I really appreciate you guys coming on. I really want to look at more into that report that you have, the 2 reports that you have. But we got to get you back talking a bit more, maybe mid-year, and we'll see what's up then.
That sounds good. We'll come back anytime. That's good.
Sounds great, Norm. Wishing you and all of your podcast viewers a very happy New Year.
Yes.
And right back at you. All right, guys. So I hope you learned a lot today with today's episode. As I mentioned, both reports are going to be available in the show notes and on the website if you'd like to download it and have it read for yourself. Okay, this Friday, we're going to have a little bit different podcast. We're just going to kind of go through the best and the worst of the year. So if you do have questions about that or comments, why don't you start posting them right now, and we'll get to all of them. All right, now, Kelsey, let's have another word from our sponsor.
Hey, just give me a second.
Kelsey, hit that button.
And we are.
Thank you, E.co, for sponsoring this episode of Lunch with Norm. Are you looking to take your e-commerce business from local to global? You can with the help of Z and their brand new app. That's right. You can track live shipments with push notifications, get detailed lead times for each stage of your shipment, and store all compliance and VAT reclaim documents in the palm of your hand, all while listening to Lunch with Norm. Ready to expand your e-com empire and take your Amazon FBA business global? Use the link in the description to learn more about Z's new app that's now available on desktop and mobile. That's Z.co, ZEE.co.
Okay. All right.
So, so just to Rob and Joe that are in the dashboard right now, if you guys have to get going, feel free to leave, and we'll talk to you later and catch up. But if not, stick around. Everyone watching, thank you for joining. Thank you for all the questions. Sorry we couldn't get to all of them today, but like I said before, post them over into the Facebook group, and we'll have a little discussion and get to see what the Beard Nation thinks about it. If you're looking for the highlights and full episodes, you can go to our YouTube channel, Norman Farrar. That's where our whole catalog is. And if you're looking for a little bit more, if you want some private group meetings and Q&A sessions with Norm and me, and even some monthly SOPs and official Lunch with Norm mug, check out our membership, lunchwithnorm.com, and click on the membership button, and you'll be able to see what we have available. So all those, all the money there goes to support the podcast. And I think that's about it.
Okay, fantastic. All right, so join us every Monday, Wednesday, and Friday at noon Eastern Standard Time. Look, everybody, you hear me say this all the time, but we could never do this without our community. You guys are awesome, and have a great, I thought it was the weekend. Here it is. I'm an old guy. It's not Friday. I was going to say have a great weekend, but we'll see you on Friday.
Lunch with Norm.